Okay, now we got it. Cool. Let's see if I can figure some of this stuff out. You guys have to be patient with me. Let me know. Can you see tonight's agenda?
And that,
Let me see. Let me try this again. Application window.
it's coming.
Okay, got it?
Yep.
Welcome to our Anchorage IBD Meetup. I've been doing this now, I believe, 15 years or maybe even longer. I'd like to mention our disclaimer that everything we're doing is for educational purposes only. Nothing we're doing is intended for you to interpret as suggesting any particular buy, sell, or hold recommendations. All investments have risk. Past performance is no indication of future performance. The possibility of loss of money is there. And I'd ask you, please don't blame IBD, Meetup, or me for any of your results. I'm an unpaid volunteer. I'm not licensed to offer investment advice. Everyone needs to take their own personal responsibilities. It's always nice to do a little bit of reviews. Let's do our first poll tonight. And the first poll is, let us know where you are. It's always interesting to me to see the dispersion across the lower 48 states. And occasionally we'll have someone even from overseas joining us. And I always wonder how they find out about it. But you don't mind filling it out. We got 86%. 88% of our 36 people so far have responded. And I've got two people that say other. Would you mind either unmuting yourself or you can just type it out in chat? Where are you if you're in other for the two people that marked other? Oh, Ireland. Okay, Ireland. That's cool. Probably pretty late hour over in Ireland right now. How about our second person? We'll see if they choose to respond or not. Looks like I might be the only one from Alaska here. Let me end the poll. I think if I end it, we've got 90% participation, 2 a.m. in Ireland. Wow. So share the results. We've got 30% Pacific, 5% Mountain, 22% Central, and wow. The winner tonight is those of you in the Eastern time zone, 38%. That always pretty much amazes me. And the next poll question is about current market exposure. We're only going to have two poll questions tonight, so not going to worry you out on that. We give it about 10 more seconds for you to find the right button and click on it. Okay, I think that's enough. We got 85% participation, so share the results. So 6% are minimally invested and 3% are on margin. 28%, either 90 to 100% or 40 to 60. So you can see the dispersion there. It's a pretty good little dispersion of various levels of exposure. I just find it interesting to ask questions like this.
It's pretty evenly distributed. It's interesting.
Yeah, it looks pretty good. Let me get back to sharing, and I want to get the agenda back up because I've got something I want to share with you. I think I'm going to skip the big picture for right now. I want to show a couple of slides I prepared. Can you see this slide on the year-to-date leveraged ETF performance? You see that one?
Yep. Yeah.
So if you'll notice, SOXL's it's just struggled this year, and SOXL's been up as much as almost 80% and down almost 20%. It just hasn't performed, and I think that's a result of all that's going on in the semiconductor businesses. You'll see that the top performer, FNGU, that's an exchange-traded note that simulates the FANG index. The financials, FAS, looks like the least volatile ETF of the five they've shown, and it's up 95%. These are as of about, I think I put this together maybe on Saturday. And TQQ is the highest it's been all year at 62%. If someone does buy and hold, which we don't necessarily advocate, it's better to have buy and sell rules. It shows you a relative comparison between five of the more popular and higher volume exchange traded funds or exchange traded notes. And then I thought it was interesting, something I found back in September in the newspaper titled Divided We Rise. And it says that the S&P 500 has typically performed better when one party doesn't control the White House. I think we all know, I think as of a few days ago, they announced that the Republicans have both houses and the presidency, the GOP sweep, which on this chart since 1958 has only happened. And these are 2-year election cycles. So there's only been 4 2-year election cycles when Republicans had the full sweep. Looks like the Democrats have had the full sweep about 9 times. And the majority of those purple bars is when it was divided. So if this chart has any relevance for what may happen in 2025, it indicates that it might be a little bit challenging. Things could go either direction, depending on what's going on, not only in the US, but across the globe. To help keep things in perspective, I put a chart together. Let me blow this up a little bit. About 8 years ago, I put this chart together using the Dow, because I could find the Dow prices pretty easy all the way back to, looks like about 1905 or 1906 is when I started. So if you notice, we have a log scale on the y-axis and a date scale on the x-axis. We had a gap down during the Great Depression in about 32, 33. Starting right over here in about 1933, the Dow was at 100. And it took until 1972 before the Dow hit 1,000. I remember that quite well when it hit 1,000. I don't remember the 100. I wasn't here then. But I remember the 1,000. Then notice all the way to 1999 for 10,000, which most of us probably remember. So I looked at this and I noticed that it looked like here's 39 years to go up one log scale from 100 to 1,000. This is 26 years to go from 100 to 10,000. And I said, what happens if it takes around 38 years for the Dow to get to 100,000? Would that be like 2038? I put this one dot right here. I put that dot 2 or 3 days ago when Dow hit 44,000 for the first time. You'll notice the market goes up, the market goes down. Sometimes there's challenging times or whatever may be going on, but that line I draw actually encompasses the majority of those blue dots, which are prices on the Dow. And so this is, if history repeats itself, it's suggesting we could see a Dow 100,000, maybe in 14 years. And then the question might be, how many years before we see a Dow 1 million? If this chart is accurate, we might see Dow 1 million within 50 years. I just thought this would give a little long-term perspective. Sometimes we get challenged when the market does something on a particular week or a month or whatever. And obviously there's times when we need to sell and go to cash. But overall, on a long-term basis, the trend is definitely up. And I even give you an equation here if you ever want to check it out. That's the equation of this line right here. It's a best fit line. I'd say the Dow's long-term growth rate is 7.2%. Plus the dividends, because this doesn't account for dividends. Nothing's reinvested here. I don't have a graph for the S&P 500, but I did a mathematical examination, and I think it was over about 40 years, in S&P 500, it just hit, I think, 6,000 for the first time last week. It goes up on the average about 8.9% per year, plus dividends, so maybe 10.5 or 11% or so. So I think that maybe just helps us think about getting things in perspective a little bit sometimes, in terms of we oftentimes have a very short-term focus. Let's go over now. Let me stop sharing this and look at the big picture.
It's really good stuff, Floyd.
Yeah, every once in a while I look at that just to bring myself back to maybe a different state of mind. Can you see the big picture?
No.
I don't know what I'm doing wrong, but let's
That's my niece.
Do you see it?
No,
Okay.
it doesn't say if you're sharing your screen yet.
Okay, let's get our act together here. You're dealing with an old dog.
There we go. Yep. Now we see your slides again.
So you see the big picture now.
Yes.
Okay, so I think all of you that have been with me for a while know that I recommend you read the big picture every single day that there's market action. It takes you a maximum of 10 minutes to find it and read it. And in those 10 minutes, you'll know more about the market than probably 90 or 95% of investors in the whole country. There's also a video, like this is a 15-minute video right here that talks about today's action. And if you use this little gear lever here, you can even speed it up to 125% or 150%. It doesn't take 15 minutes to listen to it, but there's usually some good commentary about the market, interest rates, and they usually cover 3 stocks. One of the stocks they cover today is one of the stocks that I own, which is a South American financial institution. Warren Buffett owns 100 million shares of NU, and we talked about NU today. So here, let's just see what typically is in the big picture. This is the stock market slides amid Powell comments. I'd say 8 times out of 10 when he comments, the market goes down. He made comments today, and then the market started selling off, and it turned pretty dramatically. And it says Tesla extends losses. So stock market ended squarely lower Thursday as Wall Street reacted to comments from Fed Chair Powell. Magnificent 7 stock Tesla sold off further Thursday on a pace to end with a weekly loss. Indexes closing their session lows. I'm not going to read the whole thing to you here, but it says volume fell, so we didn't have a distribution day. But 9 of 11 sectors ended lower. Thursday afternoon, Powell said U.S. economic strength will allow central bank to be patient on lowering interest rates. The economy is not sending any signals that we need to hurry. When he said that, the market wasn't super happy, so bond traders scaled back chances for a December rate cut. Odds for a quarter point reduction fell to 62%. Disney was a clear winner. Salesforce, Cisco, Magnificent 7 stocks ended lower. NVIDIA moved up 0.3%. Tesla skidded nearly 6%. Innovative 50 tumbled 3%. There were a number of big decliners, including Kava, which continued to fall after Wednesday's brief spike. They reported earnings, and Kava spiked up, I think, to 170, I think it was, and then now it's 135 or 140 or whatever. So it's been pretty amazing to see the changes there. But IBD recommends their exposure to continue 80 to 100%. Here's some of the leaders up on volume, leaders down in volume. So I recommend you go through this every day. It doesn't take very long at all.
You were talking about Warren Buffett. What do you make of him holding $325 billion in cash?
It's just, I have an opinion like other people do. It seems like he is suggesting that he's not finding any good bargains out there because he's a value investor and wants to buy good companies at a cheap price and then hang on to them for a long time. But I don't know. What do you think, George?
To hold that much cash, that's a red flag for me.
Yeah, and I think his style of investing, is he like 95 years old? His style of investing is probably different than it was 10 years ago, and he lost Charlie Munger, so he may be a little more conservative. But anyone else have an opinion they'd like to share with the group about Warren's big cash holding?
I think when Warren lost Charlie used to be the more risk averse because Charlie's background's inside more of a lawyer standpoint, and he always held back what Warren has done. So I felt like cash hoarding was more of a lingering legacy from Mr. Munger.
Okay.
And Warren is also aging and hiring new fund managers too. He might be a little bit more aggressive, but I think that should take years to fruition.
Thank you. And this is the ideal, perfect time. Hailey, why don't you introduce yourself to the group? Hailey is the only person we ask far and wide. Anybody want to think about transitioning in and eventually taking over this group? And here's our man, Hailey. Tell us who you are.
Let me pull up what I wrote really quick.
Sure.
Hey everyone, my name's Hailey. So my elevator pitch won't be very long, it'll be about a minute. So my elevator pitch is I began my investment journey over an internship over at Morgan Stanley, where the financial advisor taught me about the universe of stocks. He taught me things from like Charlie Munger's like fundamental strategy. So I read his books, and he also taught me how to make money in stocks written by William O'Neill. So I blended those two strategies together. That's why I still follow like Charlie Munger and Warren Buffett's strategy, not just Warren Buffett. The pivotal moment came was when I read like how to make money for stocks, because I'm an engineer at heart. So whenever I read books like this, I'm like, let's do this. So we did some practice. I did some practice around the IBD. That was back in 2017. I did pretty well. So I was like, this is pretty cool. But of course, I was young. So I started exploring more books, some books by like Peter Lynch. And he also says, hey, I like going to stores. I like going to shops. I like going to retail and investing what you know. I was a computer nerd back then, which I built gaming computers. So I was like, what do I know? I know gaming computers. What do I like doing? I like playing games. So what I ended up in 2017 is I bought NVIDIA stock. And I just kept on buying because I was like, I like gaming. Everyone likes gaming cards, right? That's the world I know. Stupid decision now that I look about it. But luckily, throughout the years, I kept on holding NVIDIA stock, and that kind of resulted in my most massive gain to date. So 2017 NVIDIA, I forgot the number I bought it at, but I bought a significant amount of NVIDIA, and now I've had about a 5,000% gain on it. I was at the San Francisco IBD Meetup, and Amy Smith leads the national meetups across different areas like Alaska, San Francisco, Texas. I'm not sure if there's one in New York, but I know there's a Boston one by John.
Yeah, she does the entire country.
Yes, she does the entire country. Very good. I talked to Amy. We've seen each other multiple times over the years, and I was like, let's talk to Floyd, and we met up.
Yeah.
So
Where are you
now
located?
I'm in San Francisco, California.
So I asked Hailey a question and he hasn't answered yet. I'm a little disappointed because I really want to know what's the next NVIDIA there, Hailey?
I wish I knew. I was out of college and I was still building computers. I was like, hey, I have extra savings. I'm living in my parents' house. Let's just put all my money into NVIDIA. So I put like thousands of dollars inside it.
Sure. Congratulations to you. Anybody have any questions for Hailey? I thought it'd be good to open it up to the group. You can either type a question or unmute yourself and ask away.
Are you a position trader or a swing trader?
What's the difference between those two?
Swing trader is a shorter term, maybe a couple of days to a couple of weeks, where a position trader maybe more weeks into months,
I typically do months.
which is the kind of traditional William O'Neill style is position trading.
There are days where I day trade, but when I day trade, it means I'm losing a trade because it probably hits a 7% stop loss that same day.
Yeah.
Any other questions out there? We've got a killer lesson coming up and I don't want to cut it short, but I do want to give time if anyone has a question. Our goal is Hailey and I are going to overlap for a while and he's going to start taking on more of the role as we go forward. I don't have a particular date in mind, but I'm thinking maybe by February, by March or so, he will become the official meetup leader. Occasionally I'll be a guest speaker or support him and he'll be the leader and I'll be the helper. That's what I thought. For a couple of months, I'm going to turn 76 years old. I think I have most of my faculties, right, Rick?
In about it.
If you read medical literature, your peak cognizant ability is probably when you're in your 40s. And if you start losing 0.5% or 1% a year, I'm on this downhill slide here. So I thought, let's go out on a high note and let somebody else have fun because this has truly been fun. I've been doing it for 15 years. We've had a lot of wonderful guest speakers and we'll be looking for more.
So there's a couple of questions in the chat here. First of all, before you just said that, somebody said, Bill Scott said, 76 is the new 40.
Yeah, Bill, I'm with you.
I'll reply to Rick Danielson's.
Yeah.
Are you options only or are you trading options? I do trade in options, but most of the time when I trade in options, it's because I'm trying to hedge my other position in my stocks. Because when there's an earnings call, I want to make sure that if I have already a 20% gain, I keep that big chunk of gain in case there's a gap down. Once there was Fastly stock, I owned like 30-40% of my portfolio in it. I had a 25% gain. I was like, oh, I'll be fine. Next day, gap down 70% because they stopped serving USPS. I was like, what the F? I lost over 10% of my portfolio that day and I couldn't believe it. So I learned how to play options because of that.
Thanks for sharing that.
So asks, Hailey, can you speak to your process today? Daily, weekly, monthly process?
Sure. I'll share my screen for a moment and I'll show you my market search.
It sounds like a long answer, but I know Floyd's got a good presentation coming.
Yeah, no, it's fine. We got time. We got time. Oh, there's NU right there. New.
Yep. So when you were talking about it, I just wanted to look at the chart, seeing what the heck's going on.
Yeah.
So my process is let me shrink this guy. Let me expand this. Let me do a sing-song voice. So I pretty much always look from left to right. So I look at, is earnings going up? How's book value, sales, and EPS? am I increasing or decreasing, both on percentages and numbers. So weekly is my go-to chart every single time because it gives me all the data. After I look at that, I take a quick glance over to the right. I now look at the earnings line because I always want to see this sloping upwards. I take a look at volume. Is it increasing? Is it neutral? And how's the price action? Because price is king. Price is going up, so I like that. And then after that, I tend to look at the monthly. How's it done historically? It's done very well. Has been increasing. Then it broke out over here on monthly, and it's been going up ever since. Has been holding the 10-month moving average. Then I go back to the weekly.
As full disclosure, I've got a fairly sizable position with an average price of $13.40.
So he's right about there.
Yep.
Right on.
Yeah, I've had it for
Then
maybe a month or two.
wow, that's spectacular timing.
What attracted it to you? What put it on your radar? What did you?
IBD Live. I heard Buffett was into it, so I did a chart analysis and looked at price action and went in with about a half a position. And within about 2 weeks, I was at a full position as the price was going up. Now, today was like a sort of a crazy day. They just reported earnings and the earnings looked pretty good. But if you'll notice, that's a huge bar, but it closed at the top of the bar. When I saw where it opened, I was wondering if I need to sell my position or not. And then I saw it was clawing its way back. But mainly, George, I heard about it on IBD Live. Every Saturday, I do the Warren Buffett screen on Market Surge, and news showed up on the Warren Buffett screen also.
Wow.
That's why I got into it. Was anybody else in it? Okay, go ahead. You were going to tell us a little bit about your process there, Hailey?
What I tend to really like is the mutual fund ownership index. I used to do this manually, but Market Surge finally incorporate this, which I absolutely love. It tells you how much is a fund invested in as a percentage of their funds right here, 0.77, 0.61, or 0.13. Contra fund, if it hits 1%, that's a very sizable position. 0.61 is pretty significant. All these top fund managers picked by the past Bill O'Neill, they're doing very well. Of course, I look at industry and stuff. It's not the best industry, but there's a lot of good fund ownership. Usually I don't like picking perfect stocks because history has told me that whenever I picked this top 40 industry, top tier ownership, a lot of fund management, yada, it tends to go down after I buy it. Who knows why? I've seen those a handful of times, and every single time I bought it at a perfect cut or a handle breakout or double bond breakout, it just goes downhill. But that's pretty much my daily process. It's weeklies first, going to the overall fundamentals. I can look at technicals to see if I can buy it. If it's still good, I want to take on monthly to see if there's any kind of resistance at top. There's definitely no more overhead resistance because everyone's now making money if they held it. And then I look at the daily to see exactly where to buy. Sometimes I use the 5-minute, especially on earnings, because I take a look at this first bar right over here. It's a gap down. What did it do in the first 5 minutes? It's an inside bar. Then I might have held because after the first 10 minutes, it seems like buying action came in, but then it got scary again. So this was very much a roller coaster stock to hold today, which I'm very impressed that you held it, Floyd.
I came close. I was thinking about it, and I don't have any options on it. So I didn't have to do a double trade since I don't have options on it. I've been thinking about trading options, but on a low-cost stock, you just can't get very much premium. So I was thinking about it, and I said, let's just chill out for a minute. And then what I saw as the day went on, it was making higher lows and higher highs. And so I was pretty encouraged by what was happening. And even after Powell spoke, it didn't really do much of a pullback. And it closed at the high of the day.
Right there.
I look at what the projected earnings are and what the PE is. My analysis is that within a year, this would be a $24 stock. What do you think, Hailey?
This stock, you're going to have to hold for months. You want that $24 because it looks like it's stair stepping up a little bit. It's not going to be a high flyer or anything, but it's definitely going up.
If it was a high flyer, it would have gapped up today.
It did.
It gapped down.
Even the earnings, it's the highest earnings quarter ever and it gapped down. I'm like, what the heck? It's the highest sales ever, which matches the highest earnings ever.
But the percentage gain wasn't the highest.
The percentage gain wasn't the highest, but the number was an all-time record for 2024. Maybe some future forecast was a little bit lower, but still, it's up and up.
And I don't know if you know what those little green arrows are where you had your cursor. Do you know what those little green upward arrows are on the earnings forecast?
Talking about these?
Go to the left.
Forecast. Yeah.
Yes.
The analysts recently increased their forecast. So a green arrow up is a good thing.
That is a good. That's so weird that I gapped down today. I wasn't watching this stock. Let me go back to chat to see if there's any other questions.
It's hard to guess when they're getting.
Well, do you use stop losses on a regular basis?
Yes, I do. So every single order I do, I always put a 7% stop loss every single time because I've been burned in the past. Some days, like, I'll do it tomorrow after I finish trading. Then all of a sudden, a week later, I still haven't put it in. It's just my human mistake. So I just had a computer do it automatically every single time I put a buy order, 7% stop loss every time. And so there is an exception to my rule is if I do a half position in my portfolio because it's a high flyer, then I'll do a 14% stop loss. Position sizing will reduce my portfolio loss, even though I have 14% stop loss, but it's only a half position.
Oh, thank you. Thanks for sharing that.
You're welcome.
Okay. That's probably enough for now, unless you have anything else you wanted to share before we get into our lesson here, Hailey?
Nope.
Okay.
That's it.
Thanks for the questions people submitted, and we'll see what there'll be time for questions later. But I'd like to jump into the lesson I prepared. Let's see if I can spin it up here. Can you see a lesson that says Introduction to Options?
Yes.
Thank you. Okay. But I may need to move my window out of the way here just a little bit. So I've done multiple presentations on options, but I don't think I've ever done one involving leveraged ETFs. This is me and educational purposes only. And if you really want to have a good introduction to options, mainly with stock trading, you can look at my March 2024 presentation. Here's the link to the video and the slides associated with that video. If you have an interest in options overall and would like a primer, this March 24th presentation will be a good one for you. I'm going to repeat a few of the slides from the March 24 presentation, but the majority of the slides are brand new that you've never seen before. My thought is, here's my thinking on options. Some of you might go, man, Floyd, I don't want to hear about options. And that's fine, but I think if you have an awareness of options, especially if you've ever heard of something called triple witching, when contracts expire and futures are expiring and different things are happening, that sometimes the options market can drive the whole market. If you have an awareness of options or why people are trading them, the number of contracts traded every day is enormous. Institutions are all over options. I'm going to give you a bit of awareness tonight. I've been trading options for at least 30 years. I've traded thousands of contracts, and it's really enhanced my overall performance and net profits. I'm a believer. And so I have a bias. And so understand that as I make the presentation here, and each person has to make their own decision. But let's just move forward. Let's see if I can get my presentation. It's not advancing. Okay, here we go. Now we're advancing. So there's only two types of options, calls and puts. All option strategies involve either you're doing a call, doing a put. Sometimes you do a combination of those. An interesting trade that I do quite often is called an iron condor. It involves buying and selling calls and puts at the same time. We're not going to talk about that one tonight. You can either buy or sell an option, and if you sell an option, you receive premium. It's called a credit. If you buy an option, you have to pay or a debit to cover the premium cost. So let me give you a simple example from my previous presentation of what the heck is a call or a put. Maybe you'll relate to what I'm saying. Think of an online auction of classic automobiles. You call the option company to place your bid because you think a particular classic automobile is undervalued and it's going to go up in value. So you want to buy, or you want to call that company and place a bid for that car. A put option's a right to sell. And let's say, think of it again about the automobile thing that I gave an example for. And you put your classic car up for auction because you think the value is topped and you want to sell. So the classic car value is determined by its type, age, miles, demand, and a lot of other factors. And so are options. Options, depending on how heavily traded the security is, what the volatility of that security is, what the sentiment in the market out there, what the strike price is, etc. So there's a lot of factors that go into determine the price of an option. This is a little graphic out of IBD's option course, which you can subscribe to and do online training. It shows you that if you are a buyer of a call option, that gives you the right to buy the stock at a certain price. If you're a seller of a call option, then you have the obligation to sell the stock at a certain price. Puts give you the right to sell at a certain price. And if you sell a put, you have the obligation to buy that stock back at a certain price. There's probably 30 or 40 option strategies. I only show 9 on this slide. And I'm going to do a deep dive tonight on the easiest, most common, most simple option trade. You can do it in an IRA. You can do it in a retirement account, and you only need level 1 option approval. So anybody can do covered calls. I'm not saying you should, but you know what your risk is, and it's a way to enhance your recovery or return on it. When you sell a call, it's a credit trade. Let's say you sell 10 contracts and it's worth $1 a share. Within a day or two, you're going to have $1,000 deposited into your account, and nobody can take that $1,000 away from you. A covered call is a credit trade. What makes up a covered call? So it's a financial transaction which the investor sells calls against a security that they already own. And it's a really important thing to know that you have to own at least 100 shares of a particular stock or an ETF before you can even sell one contract. So covered calls a popular option strategy to generate income in the form of option premiums. Investors only expect a minor increase or decrease in the underlying. To execute a covered call, investor holding a long position in an asset sells call option in that same asset. It's often employed by those who intend to hold the stock or the ETF for a long time. It's ideal for investors who believe the underlying price will not move much over the near term. But the main point here is that if you own 100 shares of a stock or an ETF, you can sell one call for every 100 shares. You do have to have option trading privileges with your broker, but you only need level 1 coverage to do covered calls. If you apply for level 1, I've never heard of anybody being rejected for level 1. So what is a covered call? You will have a minimum of 100 shares. You can do one contract for 100 shares. Sometimes on the order ticket, it may be called a cover or a buy, but it's only called that if you're doing the purchase of the stock and the selling of the call option at the same time. And I rarely do it at the same time myself, but you can if you want to. It can generate periodic short-term income. And you can develop a structured program of selling covered calls every 2 or 3 months for over the years. And you literally can take your cost of a stock down to zero. And I've done that. It may take a few years to do that, but if you buy a stock, say for $30, and every quarter you're selling options for $1, the first year your cost of that stock goes down to $26, and the second year goes down to $22, and it can go all the way down to zero. I think covered calls work great for a dividend paying stock, and I sometimes try to match the dividend to the amount of premium. One of my favorites is Chevron. CVX, it pays $1.63. It's currently paying $1.63 every quarter, better than a 4% dividend. So I look for short calls with a premium of about $1.63, say for 2 or 3 months. I have options that expire tomorrow on Chevron, and I'll sell more. It has this covered call has a significant flexibility because you can choose any number of strikes and any number of contract durations. I'm going to give you a homework assignment for those of you that want to know more about options. How do you take a covered call option and turn it into what's called a collar trade? And what is a collar trade, which I'm not going to describe to you tonight. But why would you want to create a collar trade? And the hint is, if you have a stock that's run up in value and you want to make sure you protect that value, you can set up a caller option, which means after you do that, it's literally impossible for you to lose money on that stock. Okay. So let's see now, what strike prices do you want to consider? Because when you do an option, if you're going to do a call option, you have to choose when should it expire? How many weeks or months do you want to hold it? And what is the strike price? I'll describe that to you so that you understand what that is. An out of the money call, which is what I do most of the time, the strike price is higher than the securities price. So if the security is trading at $100 a share, an option with a strike price of 120 is out of the money. There may be times when you want to sell at the money, meaning the strike price of your option is the same price as the security. And sometimes you may want to do in the money, the strike price is lower than the security. Normally, you'll be selling out of the money options. And so here is a stock option table from Fidelity. This is for TQQ. TQQ is trading at 82.75. I called the 83 strike at the money. And the lower prices are all in the money. When TQQ is 82.75, if you sell a $77 call, you're going to get paid about $7 a share. And then here are out of the money calls. These are higher prices. So this is a little bit of a terminology thing for you to think about. Here shows you this particular table is for options that expire 12 days. And that was 12 days from, I think, maybe last weekend. Because November 22nd, I think, is next Friday. So that's only about 5 days from now. But when I printed the table here, it was 12 days. So these are all call options. And we'll describe to you what's in this table in just a little bit. But this gives you an idea of the terminology out of the money, at the money, or in the money. How about contract duration? I love short-term contracts, 1 to 5 days. I do this all the time. Medium term, 2 to 4 months. I do those also. Rarely do more than 4 months. I have, but it's pretty rare. And you can even go more than a year. Here's an example. TQQ. I circled in red the ones I favor the most. But notice, for TQQ, there are 12 contract expiration dates. November 15th, which is tomorrow. Or you can go next week, November 22. You can go all the way out to January 2015. So for TQQ, you have 12 expiration dates you can choose from. Some are weeklies and some are monthlies. If it has a little W next to it, that's a weekly option. Options always expire on a Friday, unless Friday is a holiday. So when should you close your option? If you sell an option, that's a short call. When should you close out the position? And it may sound like a trite answer, but when it makes the most sense to meet your investing goals. Sometimes you'll let the contract go all the way to its expiration date and expire worthless. I have quite a few options that are going to expire worthless tomorrow. I'm absolutely positive they're going to expire worthless. And that's the goal. If you earn, say, 50 cents, $1, or $2 a share, your goal is when it expires, the value is $0. Other times you might want to close the contract early, or you can do what's called a roll, and you can roll the call. Let's say we have options that expire on November 22nd, and the value has gone down to 10 cents. You could roll that to an option that expires in December and earn more premium. If the value of your call has decreased significantly, say by more than 80%, you may want to close it and take your profits to the bank, or you could roll the contract to a later date. But if the stock or the exchange traded fund unexpectedly starts going down and you want to sell the security, you can place an order ticket where you can sell the security and close your short call contract at the same time in one single order. So it's easy to get out of the position. This is a little graphic that shows what a covered call option strategy is. The current price is somewhere over here. Our strike price is up here on the expiration date. And so we show everything to the right of this point is profit, and everything to the left of this point is a loss on the option. How do you read an option table? For some of you, this is pretty simple. But for others, this is something you need to know. This is from Fidelity, but the other sites are very similar, like E-Trade or Schwab or others. But you put the symbol in, and it shows you the current price. This was back on the 3rd of November. We're looking at the call side of the option table. This shows you the last price that it traded at. This is for options that expire in 19 days. Here's the bid and ask. If you were to sell this particular contract, you probably could get 47 cents. You're not going to get 49 cents. And it shows you that at the time I printed this out, there's 1,643 contracts at a strike price of 85. I like to look at delta. Delta is a good indicator of probability. This delta is telling you there's only a 9.5% probability that TQQ in 19 days will trade higher than 85. So I'd say there's about a 90% chance that TQQ on November 22 will be lower than $85. And so I like to trade options. If I'm selling calls, I like to trade options where the probability is around maybe only 10% that my strike price is going to be exceeded. I call these my chicken trades or my afraid trades. If I want to hang on to TQQ, but I want to earn some premium, I might choose this one. Here's an expanded table that shows here's options that expire in 19 days, 26 days, 33 days. So notice I've circled all of them have the same strike price of 85. With TQQ trading at 70.93, roughly a 90% chance that these are going to expire worthless in 19 days, about an 86% chance in 26 days, and about an 85% chance in 33 days. If I go out 33 days, I'm going to earn maybe around 75 cents a share, whereas if I only go 19 days, I'm going to earn about 47 cents a share. And you could go out 2 months, 3 months, you can go out longer and you'll get a larger amount of premium. So what does your order ticket look like? You put your symbol in, and if you already own the shares, you say, I want to sell call options. In this particular case, I'm going to sell 15 contracts because I have 1,500 shares of TQQ. I want to go out those 19 days to November 22 at an 85 strike. This says that the bid-ask range is between 46 and 49, so I'm going to put a limit price in at 47 cents. I only want it to be a day order. You can also, from this pull-down menu, say good to cancel, which means the order will carry over tomorrow if it doesn't trade. And the margin, this type of account, it's either going to be a cash or a margin account. You'll know from what kind of an account you have. One of your conditions might be, I want to sell all 15 or I don't want to sell any of them. I don't want to put any conditions on this thing. If they only sell 7 or 8 contracts, that's fine. The majority of the time, if I put an order in to sell 15, all 15 will sell. That probably happens 95% of the time. If this executes, it says I'm going to have $705 of premium gain, and there's a small little fee here. So actually what will be deposited into my account if this trades is $697.69 is what I would be. I think that would get deposited, I believe, like the next day. So let's look at a TQQ covered call strategy. This is Market Surge, Market Smith, whatever you want to call it. TQQ on August 14th of this year, about 1,000 shares at $63.50. So these are real trades. On August 15th, I sold a 74 strike call contract that expired 36 days later. I got paid a credit of $2.70 or $2,700 was deposited into my account. Shortly after I put that trade on, TQQ went up to 73.14 and my strike price was 74. Since I'm a chicken trader, I said, hey, I better roll those up to $76. Shares don't get called away. It cost me 90 cents to roll that up. I was happy to pay the 90 cents. So here's what happened. I bought 1,000 shares at $63.50. On August 15th, the next day, I earned $2,700 from selling my calls. On August 21, It cost me $900 to roll them up to 76. My net gain on my options, $1,800. Say that?
About 3%. You made about 3% on it. 3,600 out of 63,000.
So those expired worthless on Friday. On Monday, I sold 10 more contracts at $80 a share, 25 days out for the 1018. I got paid $820 for that contract, and they expired worthless. So now my gain is up to $26.20. When they expired worthless on Friday, the following Monday, I sold another 10 contracts with an $83 strike price and got paid $360, and those only had a life of 11 days. So my net gain is $2,980 from all of these trades. In 78 days, TQQ gained 11.7%. It went from 63.50 to 70.93. My options gained 4.7%. In 78 days, the gain was $10,410 on TQQ and on the options, but 16.4% on an annualized basis, that's 76%. I'm pretty happy about that trade. Let's look at SOXL. These are real trades. Back on November 1, I bought 1,000 shares of SOXL at $15.95. Using our stochastic strategy, we got a buy on that Friday, which was 11.3, and I could feel like that was going to happen, so I cheated a little bit and bought it 2 days earlier at $15.95. After SOXL ran all the way up, almost at the high, I shared this trade with a lot of you back in maybe at the March meetup. I said, let's go all the way out to August, which is unusual for me to do that. I went out 161 days, and I picked a strike price of 80, which is way up here. Unbelievably, I got paid $7.55 per share. I got paid $7,550. Notice the net cost of my initial 1,000 shares is all the way down to $8.40. I love a trade like this. And so I have a lot of liberty. I can let SOXL drift down a little bit and hang on to it because I only have $8.40 into it. On July 16th, way ahead of the expiration date, I said those $7.55 options are only worth 41 cents. Let's close them out and take our profit and see how that would work. If I just did the straight trade without options, I made 274% profit in 258 days. If you throw the options in, my 274% trade gain made 578%, which on an annualized basis is 818%. My net cost of my shares was $8.81. I paid $15.95. I earned $7.55 here, and then I closed it out early. It cost me $410 to close that out early. So here's what I would call a killer trade. So let's now look at a different option strategy called the long call. The long call has a lot of advantages to it. And let me explain what some of those advantages are. This is what's called a debit trade, or it means you have to pay money to buy these contracts. But when you buy the contracts, you know to the penny what your maximum risk is of the trade. You can't lose any more money than what you paid when you buy the long call. I looked at option strategies for TQQQ. If on Monday, before we knew the results of the election, in just 4 days, not being able to predict the future, you would have made 202% profit on your options. The part that is really interesting to me is after we knew the election results, Wednesday morning when TQQ gapped up and the options gapped up, if shortly after the open, if you said, hey, Trump has won the thing, the market seems to be happy about what is going here in terms of economic benefit or whatever, since I know what the election results are, my risk is less if I put a trade on Wednesday morning after the election and I close them out 2 days later on Friday, 87.5% profit. So let's see how that would work. So this is from each trade. Question?
Yes, Floyd, can you explain what is a long call? What are you buying and selling?
You are buying, this will be evident to you really quick, but thank you for asking the question. So it heightens my awareness, but I'll explain that to you here shortly. So this is a 14-day candlestick chart with 30-minute candles. And so this is a 14-day chart of the price of TQQ. And right here after the election, it jumped up from about 72.50 to about the 76.50 or so. So that's a big gap up. But notice the price stayed there in the early part of Wednesday, and then it started drifting higher, then had another gap up on Thursday, went higher all the way Thursday, and even went up more on Friday. So what we want to do is, if we're buying this before the election over here as a speculative trade, when TQQ was around $70 a share, you could buy a $70 call that expires on 11/15. So you're buying a $70 call with an expiration date of 11/15. And here it is, you're going to buy it here and you're going to sell it here on Friday. So on Monday, the $70 November 15 call is $4.20. So if you do 10 contracts, that costs you $4,200. And so that is the maximum amount of money you have risked. Now, if the election would have gone the other way, and if TQQ would have gone flat or gone down, you probably could have closed the position out and have a maximum loss of $1,000 or maybe at the most $2,000. So I really don't, the full $4,000 really wasn't at risk, but theoretically it was. But notice on Friday, just 4 days later, you're able to get out of that contract at $12.70. TQQ goes up 17%. Your option contracts gain 202% value. So your $4,200 investment gave you a net profit of $8,500. I can imagine some of you are going, hey, give me a break, Floyd. You did all this in hindsight. You didn't know how the election was going. And all of that is true. I'm giving you an example that when there's good news, and you can also do this with bad news by buying puts. But if for some reason you believe the sentiment is on your stock or your ETF, if you think the potential for it to go higher is real, you can do the trade. Now notice if TQQ is around $70 a share, if you wanted to buy 1,000 shares, that's a $70,000 investment. But we did 10 contracts at only a $4,000 investment. So let's look at what happens if we do this after we know the election results and TQQ jumps up to $77 a share. So I'm going to buy at the money. I'm going to buy it at the money long call right here Wednesday, and I'm going to sell it on Friday. So what does that look like? So I'm only going to do 10 contracts, cost me $3,200. $3.20 right here, $3.20 a share. That's what the premium cost is the debit trade. 2 days later, I sell it for $6. After the election, TQQ went up another 6.5% from Wednesday to Friday. Your options gained 87.5%. So on a $3,200 investment, you got a $6,000 income. Your net was $2,800. So let's look at Tesla. What happened to Tesla after the election? Notice how Tesla gapped up in a really big way Wednesday morning after we knew the president was elected. The options gapped up. So let's just buy a call contract right here at $282.50, and we're going to sell it Friday at around $40. So on Wednesday, 11/6, we're going to buy the $282.50 long call with an expiration of 11/15. So we're only going to do 5 contracts because I don't want to spend more than $5,000 on this trade. That's my maximum risk. And I probably could get out at a maximum loss, let's say $2,000 or $2,500. When I close the contracts at $40 a share, that's a $20,000 credit to my account. So I made a $15,000 profit in 2 days. That's a 300% gain. This is the power of options. If I wanted to make $15,000 by buying Tesla stock, I would have to have spent $100,000 and bought 354 4 shares of Tesla at 282.50 to make the same $15,000 that I made on only a $5,000 investment. Can you see the power of what options can do for you here? The 5 contracts is basically we were controlling the action on 500 shares of Tesla. I'm so impressed that the option, what we paid $10 for 2 days later, was worth $40. If I hadn't been a chicken and hadn't closed this out, I closed it out because I didn't want to carry it over the weekend. If I would have held it one more day through Monday, I could have sold those same 5 contracts at $65. And instead of making $15,000 profit, I would have made $27,500. So I had a little talk with myself and I said, Floyd, maybe you should have only closed out 3 of your contracts on Friday and let 2 ride to Monday. One of the power of options is if you have 5 contracts, you don't have to sell all 5 when you want to close it out. You can close out 1, 2, or 3 of those contracts if you want to let them ride. If I would have sold and closed out 3 of those contracts, I would have had a guaranteed profit. It would have not been possible to lose money. Anyway, that's giving you a little point here about Tesla.
Good question. When you did this buy, you don't care about the delta for those options at that time, right?
I don't care
About the delta.
at that particular time. If I'm buying at the money, the delta will be 50%. If I didn't want to, what I could have done if I wanted to get in at a lower cost than $5,000, instead of doing 282 call contracts, I could have come up here and maybe bought 209. If I would have bought 296 call contracts, maybe my cost would have only been $1,500, but then I wouldn't have made as much profit. So I bought at the money right here. And I was willing to risk 5,000. And really in my mind, the most I was risking was probably about 2,000, 2,500. But I already knew the election results. And when I saw Tesla gap up this much, I thought, well, there's going to be people want to own Tesla. Now, today they didn't want to own it. Today Tesla dove down, but from this price to this price, Tesla gained 15% in 2 days. Can you imagine how many billions of dollars that is that Elon Musk made when the stock went up that much? So tonight we provided an introduction to stock options and how to set up trades for the covered call and how to do a long call. Like I told you earlier, there's probably 40 different ways to trade options. And so I've covered 2 of those. But even if you don't trade options, having a good understanding of how options work will maybe help you understand some of the components of daily trading action, or maybe you want to tiptoe in a little bit and try a covered call, which is the easiest option trade to do. You can do it if you have an IRA account. And let's say you have 100 shares of Microsoft or Chevron or IBM. What I would suggest you do is you pick a strike price with a delta of around 0.1, 10%, or say a 90% chance that they're going to expire worthless. Go out maybe 2 to 8 weeks and try one of these on for size and see if you like the additional income that comes into your account. Maybe do it through baby steps. Sell 1 option, maybe the next time you sell 2 options, or you sell options on 2 different securities, and get yourself a level of comfort. Do I understand how I'm setting the trade up? Do I understand how I'm making money? Do I understand what my risk is? And is this something I want to continue to do? Because like I say, I've been selling call options on Chevron now for every quarter for probably 4 years. It's paying a 4% dividend. I'm making at least 4% on the options. So that's 8% gain on a good solid company like Chevron. I'm happy doing it that way. I'll open it up. You can unmute yourself or type in questions, and I'll ask for people to help me if there's typed in questions, and I'll answer the best of my ability. We have plenty of time, and I can go back to slides if you want me to review something again. The session is recorded, and I'll have the link to the recording out to everybody that's an IBD Meetup member. They'll go out no later than Saturday, will be my guess. And I suggest that you look at the presentation again, follow the slides, and make sure you have a good understanding of the call option or the covered call before you ever place the trade. And if you have questions, you can send me an email at tqqqinvestor@gmail.com, and I'll gladly answer questions you have. How about questions tonight? Can Haley or Rick, can you guys see the chat?
Yeah, I'm looking now. Do you need to own 100 shares of the stock to do options? That's a question.
Only the covered call. To do the covered call, you have to have, if you're going to do one contract, you have to own 100 shares. If you're going to do 5 contracts, you have to own 500 or more shares.
How much money do you need to be in your account?
If you're doing a covered call, you don't have to have any money in your account. If you own 100 shares of NVIDIA, and if you want to sell one contract on NVIDIA and you earn, let's say, $100, that contract is either going to expire worthless, or if you're, let's say, what's NVIDIA's price now? Around $430?
146 today.
Oh, I'm sorry, 146. Okay, so let's say you sold a 150 call option that expires in 30 days. In 30 days, if NVIDIA is at 150 or higher, your 100 shares will be taken away from you and you'll be paid $150 a share. You'll lose your shares. Now, there's a strategy you can use to prevent that from happening, but if you do nothing and the price of the stock exceeds your strike price, your shares will be taken away from you and you'll be paid the strike price. And so if your strike price is 150, your shares will be taken away from you and $15,000 will be deposited in your account and you will no longer own those shares. But you don't have to have any cash in your account to do a covered call. If you want to buy a call option, let's say the call option costs $5,000, you have to have a minimum of $5,000 to cover the cost of that premium. I hope I answered the question.
Does anyone pay attention to maintaining long-term taxation on the covered call stock shares? And or in parentheses, qualified covered call.
I think that's an excellent point. If you have a taxable account and you've owned a stock, say, for 10 months, and if you sell the stock at 10 months at a profit, then your tax rate is very high versus if you own it for more than a year. One thing you could do is go out till January, if that gets you over the 1 year mark, and sell a call option. If the stock keeps going up, it can only go up as far as your strike price, but you will then put yourself into a long-term capital gain basis, roughly half the taxes as if you sold it in less than a year. This is another reason why you may want to study the collar trade. With the collar trade, not only can you put yourself into long-term capital gains, the collar trade will make sure that you make a profit on the stock, no matter what it does. It could go down to zero and you'll still make a profit. I hope I answered the question about going from short-term to long-term capital gains. And if I missed what the question was, please re-ask.
So if you have stock and then you sell calls against it the wrong way, there's rules under, if you Google qualified covered calls, that say you have to sell it above 30 days to expiration, and it has to be certain strikes above the money. Otherwise, your long-term taxation on the shares can get disqualified. So that's what I was talking about, like which strikes and days to expiration you choose in order to keep the stock qualified for long-term later on.
Was this John?
Yeah.
John, maybe I need you to put together a mini presentation for December. Explain that in more detail, because I don't think I'm completely aware of what you're talking about. And I've been trading options for 30 years.
Okay. I don't have a presentation, but if you search those 3 words, qualified covered calls, and you look for the Fidelity article on it, it will take you to that. And then also the Internal Revenue Code that the IRS talks about it.
Now, John, do not tell me I have to read the tax code.
Read the article. It is an actual code.
Thank you for speaking up and saying something here, because if someone has a short-term position and they want to convert it to a long-term position, what John has told us here is you need to go read an article about what.
I'll paste the link here to the article.
Thank you for bringing this up, John. I totally appreciate it. Otherwise, I may have misled somebody. and you may have end up having to pay short-term capital gains if you pick the wrong strike or wrong expiration date. So is it really simple to understand, or is it complicated, John?
I would say it's medium. It will take some time.
Okay.
The link is there.
I'll go read the article probably tomorrow. I appreciate you 100%, John. I appreciate you speaking up and helping us. We're all in this together, and we're all learning and helping each other out. You're my hero today, John. Anybody else have any comments? Feel free to comment, or if you have a question, and if I don't know the answer, somebody in the group here probably knows the answer. So
Paul asks, how do you handle the options if you hit a sell rule and you sell your TQQ position before expiration?
You have 100 shares of TQQ and you have one call contract. The best way to handle this is to sell the shares and close out the option position at the same time. And that is, you do that in one step. If you want to do it in two steps, you must close out the option position first before you sell the shares. I like to fill out the ticket and do it together. If I want to close out a position, I just close them both out at the same time. And so when you bring up your holding in your account and you say you want to close the position, if you have a good trading platform like E-Trade or Fidelity, they'll bring up a ticket that shows how many shares you own and how many contracts you have. And then you can do a order to close out your position, and it will tell you the bid and ask price, and you can either do a market order. If you want to get off fast, you just do a market order, or you can put in a limit order. But if you have them both open and you want to do it separately and you want to sell your TQQ shares, you must close out your call options first. If you don't do that, then you have a naked position. If it's an IRA account, they won't let you have a naked position anyway. They'll reject the order. So I hope that answered the question.
I do something similar with options where I sell puts on the 100 shares I own, and I do this weekly to collect premium. It does work very well.
Yes, you can. You just have to look at calls and puts. You can look at whether you want to buy a call, buy a put, sell a call, sell a put. There's probably 40 different ways and maybe even more than that to trade options. And so I guess who made the comment?
Rick Danielson.
So Rick, would you mind unmuting yourself and give us an example of a trade you've done like that?
Sure. Can you hear me okay, Floyd? I do it every week. So normally what happens is, for example, I happen to own 100 shares of Berkshire Hathaway. What I do every week on Wednesday, I will sell a put against Berkshire Hathaway. My son ran a program for me to see how far a stock share will drop in a week. What we found is that if you go from the current prices, if you go down, the most that it's ever lost is averages about $12. So what I do is I look at the price between $15 and $20 below whatever the current price is of the stock. So if the stock is selling for $4.65 a share, I go down and look at either the $4.45 or the $4.50, kind of look at the trend to see what it's going to do. And if it looks good, I might sell the $15, the put at $15 below. If it's at $4.65, I might sell the $4.50, or I might sell the $4.45. I collect the premium. It would be for not this Friday, but for next Friday now.
But it has a 6 or 7 day expiration date.
It's about 6 or 7 days.
And typically, do you ever look at what the delta is on those strike prices?
No, I'm not worried about the delta at all. I know that with the program that we ran, the data that my son had was that it was safe. I've done it for 3 years, and there's been 3 times in 3 years where that stock has dropped more than $20. That's it. So I know it's pretty safe.
Did you just close out the put so you didn't have any adverse action then?
Correct. And that's the only thing that I do. I don't let them expire worthless. Every Friday, I buy it back for 1 penny. And so it costs me $1 to buy the contract back. And that way I don't have any worries about some easy swing price at the end of the day.
And so,
Correct.
So Rick, when you, and only share as much as you want to share, but on, for example, on Berkshire, when you drop down, say the $15 or so, do you have a minimum target option you want to earn? And if you don't get that much, do you just wait until the next week?
I'd say for the most part, I'm trying to pick up somewhere between $30 and $50 a week. So I'm making anywhere from $120 to $200 a month.
So in other words, you're looking for 30 to 50 cent premium.
Correct.
Excellent. Appreciate you sharing that with us, because there's so many ways to do the strategies here. And if we each use our own brain power and figure out what works for your personality. So Rick is just giving you a strategy that works almost exactly the way my strategy does on what was when you're selling calls and he's selling puts. And we end up making, both of us make money. It's just doing it a different way.
It works very well. Thank you.
That's really cool.
I really appreciate you sharing that. Is there a name for that strategy?
No, if there is, I don't know. I don't know what it is. It's my strategy. So that's what I do.
Okay.
Sounds like it's a covered put, right?
I would say it's selling covered puts.
Thank you, Rick. I appreciate you sharing that. For those of you still with us here, think about what he just said. He's happy with $30 to $50 a week of income coming in on the strategy, and just do it every week. And after a while, that adds up to some money. And if he had 500 shares and did this, then it'd be 5 times as much per week coming in. And so you can look at, and you can do this with the leveraged ETFs also, but if you end up having a position where you have, for whatever reason, maybe you got a stock a long time ago at a low price and you've got a fair number of shares, before you know it, if you're moving, like I've had positions where maybe I'm selling 50 contracts. If you're selling 50 contracts and you get $1 per contract, that's $5,000 just dropping in your lap. And you can do that time and time again. You can start off small and baby steps, and we can just share things. I really appreciate, Rick, you muting yourself and sharing that. So we have a little bit of time if there's any other sharing out there or questions, and there's no crazy questions.
Floyd, this is Watson.
Yes.
Is it okay to ask a question about the leveraged ETF strategy, the TQQ?
Yes.
I need to make sure that if people had any option questions, I would wait before I asked.
No, you can do that. People have had time to formulate their questions. And so what's your question?
For a long time, we had the overbought and oversold at 37 and 10 respectively. And I know there were some changes to that number, but in the new strategy, are there different values of overbought and oversold when you buy versus when you...
Is Gary on here? No, Gary's not on. Let me bring up Trading View. Can you see Trading View?
It's loading.
Okay, this is TQQ on Trading View. You see that? Okay, so notice we had a buy on the weekly strategy. We had a buy on Friday, September 13, and we've had no sells since then. And here are our ranges. So let's look at our window. Our strategy will exit if the fast line drops below the slow line and goes all the way down to 28, which I think is this dotted line right here. The longs are entered between 12, which I think is this line, and all the way up to 65. And Gary's working on a program where they're going to change these descriptions.
So the overbought and oversold when you're buying is 60. 12 is oversold, 65 is overbought, right?
Yes. 12 is oversold, 65 is overbought. So we can enter the longs anywhere up to 65. On the selling, if you're going to sell, you may hit one of these stops, like your 1 day stop or your trailing stop. If you don't hit the stops, the fast line has to come all the way down to this number right here before you sell.
And that is 28, right?
That's 28.
Okay, so then what is this 12 and 57 for shorts?
That's why Gary's going to relabel this thing, because that's misleading. I wish Gary would be on here so he could describe it better for us. For right now, for today's purposes, I wouldn't even worry about this 12 to 57.
Yeah, I think it's only for the purpose, right? It's for a feature that's not in the program, which is shorting the stock. Maybe he's planning it for the future or something.
Okay. Thank you.
I hope that helped. But for now on the weekly strategy, you do not have a sell signal. You're following the strategy, you bought back here. And even with this downturn, you held on to it because the fast line didn't get down to 28. Right now, according to Trading View, they're tied at 74. But TQQ can move pretty quickly, so we could have a sell signal as early as next Friday. If TQQ starts going down and this fast line starts diving, okay, I hope that answered it.
And regarding SOXL, SOXL, are we currently in a sell signal?
Let me move this guy out of the way so I can find my SOXL. Here was a sell on the 28th. That might have been because of the one-day drop. We had a buy over here on the 8th. If the fast line crosses below the slow line is below 32, and the fast line right now is like at 19 or something. But see, it's not Friday. Today is Wednesday. You show up on Fridays, we have a clear sell signal. In my opinion, there's a sell signal already occurred, but it won't show up until Friday because we're below 32. Last line's at 18. And you can see up here, the price action has been pretty negative.
Yeah.
Recently, we were up here at 41 something now, and here we're all the way down to 29. So clearly, the semiconductors are weak and lagging. We bring up Market Smith and we bring up, or Market Surge, I think it's called now. Let's see. If we bring up SOXL, you can just see we're below the 200, we're below all these moving averages. We're below 30. Unless something unusual would happen, Trading View is going to show a sell signal on Friday. And if you want to cheat and get out early, no one will criticize you.
Just observing the volume bars, there's a lot of reds.
Some people call these skyscrapers, some people call them icebergs, but look, there's a big red bar, there's a big red bar, there's a big red bar. Here are two over the moving average for volume. We've had 1, 2, 3, 4, 5 negative days in a row.
Yeah.
And if you look at NVIDIA, which is part of SOXL, NVIDIA's not like that at all. If you look at maybe LRCX, somewhat negative. Let's look at ON. See, ON's been really negative. Let's look at Texas Instrument. I'm just to think of the ones that might be in the index. Not too bad. How about AMD? Let's look at Avaggo. So you need to know what makes up the index. There's been some down days here. I don't know what's really going on with the semiconductor indexes. I have a theory that they're spending so much money building new factories that the capital budget required for all the construction they're doing is going into building facilities that haven't yet built anything they can sell. So their profit margins are down, but hopefully if they're building these factories and when they get completed and they start building more chips, then their profits will skyrocket.
They've been building all these factories even in Mexico. These are American companies. Now, I don't know what would happen to the tonnage if Trump reacts.
Yeah, I don't know.
If the impact of yes. I didn't mean this to be a political thing, but I was more curious about what implication of tariffs on these American company-built factories. And would they be considered made in Mexico and brought to America, or God only knows?
They're building factories in Arizona, New York, and probably some other places. The goal is to bring the manufacturing to within one of the 50 states, not Mexico or Canada. But they're investing billions of dollars, and so it's a gamble of whether that is going to be a wise investment or not. When you saw that one graph I had where we were comparing SOXL to FAS, I mean, it's night and day difference. Look at FAS. It's almost at an all-time high, the total opposite of SOXL.
And it's partly because of the SNCI finance fiasco that is going on with the
Well,
SEC.
SMCI is not part of the SOXL index.
It's not, but it is one of the suppliers for NVDA. I also heard news about NVDA regarding their financial stuff.
Probably a lot of things are connected in ways that we don't totally know, but it's interesting to me if you look at FNGU, which has some of those same kind of stocks, but not all of them. FNGU is fairly close to an all-time high. And so it's just interesting that because FNGU, they have NVIDIA, AMD, maybe that's the only two. I'm not sure what Snow does. They have Snow also, and Microsoft. So they have some stocks associated with hardware. If we put in FNGU over the last year, we can compare that to SOXL. SOXL is up 33% and FNGU is up 164%. And look at all this negative action that's happened since August, roughly. So it's got a serious downtrend and FNGU's got a serious uptrend. So you have to pay attention to what's going on out there to know where your money needs to be going. And our buy-sell program will help you do that a little bit because if you're in SOXL, you're probably in cash right now. And so do you just hang on to cash and wait until you get a buy signal on SOXL, or do you look at TQQ? TQQ is halfway between, but it's been in an uptrend here. And let's look at the TNA, which normally is not something that has done very well, but TNA has, it's just a short-term move here. And what was one of those other strong ones? Let's see.
Add FAS into it, Floyd.
Oh, yeah. Why couldn't I remember that? Yeah. So FAS is almost as good as FNGU here for the last few months. Long
Both
term,
those are right.
no, FNGU is not financial.
Okay.
FNGU is the microsectors FANG index, which is Facebook, Apple, NVIDIA, Google. FAS are the banks.
Gotcha.
So this, even though the performance is almost identical, they're totally different industries. And then you look at SOXL, that's the sad sack of the whole thing here. On this 1-year comparison window, and we can go out and look at it and say, how about on a 2-year comparison window? And on the 2-year window, FNGU is the clear winner and FAS is way down here.
Historically, for bull markets, the semis tend to do well, right?
Yeah. Yes.
There's some other comments and questions, Floyd, about the options.
Yeah, let's jump back to options. I'd love to answer questions that people might have.
One comment here, detailed. Rick says, a way to get an idea of how much price might arise is to sum the prices of the at-the-money call and put premiums, then add that to the current stock price to get the expected high price by expiration, and subtract that sum from the current stock price, and that's the bottom of the expected range by the expiration.
Yes, that's an excellent point. What you can do, if you go to the money, let's go back and look at,
I understood that.
I think I have an example of this. So here's at the money. At the money on TQQ, it says it's about $3. They're saying expect by expiration to go up or down about $3. So that'd be about 85. Our strike price would have been probably 85, or maybe go down to 79. Rick, do I have that right? If we look at the money and that's $3, at least on the call side, that's the expected move by expiration, right? Rick?
Beat.
Maybe.
Yeah, but he's saying sum the call and the put premium.
No, you don't sum them.
It's just,
You should sum this to create a straddle price, and then that's called the implied move or expected move. So it's the straddle price.
So in this particular example, do you go up $3 and down $3? So the straddle.
No, the straddle price would be approximately $7.
So if this is at 83, you would do a $90 straddle?
The straddle is done at the money to calculate, right?
yes.
And then the expected move is up and down that amount. So it would be 90 on the upper side and 76.
But the thing is, the options that expire in 12 days are saying expect it to go from 82 to 90?
Yes.
Yeah, and if you look for swim on the upper right, they will have the E expected move amount calculated by them.
Okay.
And it will be approximately the at the money straddle,
Okay.
the sum of put and the call.
Because if you go all the way to 90, your premium is going to be a pretty low number. But it's a safer trade because odds of it getting called away from you would be much less. You're just going to earn less premium.
Where you sell, that's all the expected move says is that 68% of the time it will be within that range.
Okay.
So it's not 100%. One expected move is one standard deviation, which is 68%. On a normal distribution, one standard deviation will contain 68% of the points.
I like,
if you go,
maybe we get there the same way. I like to use delta. For example, in this one on the screen here, this is an option that expires in 19 days. It says there's a 90% chance that TQQ will close at 85 or lower.
When you use delta, delta is at the one expected move line.
Okay.
Yeah. If you're able to bring up Thinkorswim, it would be easier to show.
Let me see if I keep
it like on a paper account.
I don't know if I can do that, but let me just close a few things down here. Here's Thinkorswim, so let me open it up. I'm not a really good user of Thinkorswim, but I'll bring it up and then you could coach me through on where to go.
Just go to the paper site so you don't show anything.
My Thinkorswim account only has like $1,000, so I don't care.
Okay.
I opened a $1,000 account so I'd have Thinkorswim access.
It's an amazing tool, even if you don't use it to trade, but for research.
Yeah, I agree. Are you seeing me loading up Thinkorswim?
Yeah, we see it.
You'll see that
like you'll go to the trade tab and put in the ticker.
Okay.
You got to agree to something.
Yeah, I agree.
A new 24-hour talks they're going to have.
Let's see, what is this? Oh, I have to agree to something. I guess I'll agree to all of it, whatever I'm agreeing to.
That's a new thing that they.
I got a ding because there's a sell signal on SOXL over here. So which tab do you want me to go to?
Trade tab, the second tab.
Got it.
And then open the expiration that you want.
Okay, let's go to December 6th. So that's 22 days.
Okay, and then I'm going to...
Let me get rid of SOXL. Let me put in TQQ because I don't want to hold SOXL, but let's do TQQ. And we're on December 6th. Okay, so now what do I do? Probably want to expand these strikes, don't I, to something greater?
You can actually see if you go all the way to the right on that line where it says 6th December, all the way to the right, right before that, you see the expected move and it shows you the percentage of IV.
So it's what, 8.25? Is that what we have?
Oh, yeah, right there. That's the expected move, $8 by this date. That's what it means.
$8 higher or lower.
Correct.
Cool. Thank you for
So
showing.
current price plus $8 on the upside and minus $8 on the downside.
The percentage is the probability of that?
68%. It will be within that range. That's not absolute. It's not a max and a minimum. If you go 2 expected moves each way, that will contain 95% of probabilities. So it's all in how certain you want to be.
What do you mean by 2 expected moves?
So instead of going 8 on each side, you go 16.5 up and 16.5 down. That would be 2 expected moves on each side. People doing iron condors and wanting to have a high probability of staying in the middle many times go above the 1 expected move in order to have a high probability trade.
Sounds like that expected move is similar to a 1 standard deviation.
Roughly the same.
Right now, TQQ, it says it's at 80. So I guess I have to do all here. Let me just go all. I want to see what the premium is. If we say it could go as high as 88, what's the premium? It looks like 87 to 91 on that side and going down to 72 on the put side. So it'd be $1.13 to $1.18. So if you wanted to do double, like for an iron condor, if you did double, you're probably not going to earn very much premium. And plus you're only going out 22 days. I really appreciate you showing me. That's a good piece of extra information to have. So thank you.
Sure. I believe Tasty Trade's platform, which I do not use as a broker, but they highlight in the chain, they will highlight the expected move with a color to visually show you.
Okay.
I just want to stress, it's not a max and a minimum. It's just the probability.
I've been successfully using Delta. I need to do a comparison and say if I use the expected move. Does that make me a smarter trader or not?
Around 16 delta.
If you look at the top bar there, it says single, and then next to it, it says last X next change. Do you see that?
Over here?
Yeah. So click on that layout, click on that.
Just click right on last X.
Look, right?
Your cursor.
Let's go.
A little bit. Nope.
Click
Where's
on
it?
the word
Click it.
last.
Yes.
Click.
Right there.
No, no,
yes.
above.
This is correct. So there,
Up here?
no, you're
Okay.
right. You're correct. Just click on customize. You see that customize there?
Yeah.
Yeah, click on that. Yeah. Now just type in on the lookup, just type in delta.
Thank you. That's what I wanted to
There you go. Double click on delta.
It moves it to the right side.
Yeah, just double click it. It'll go to the right side. Yeah,
And-
there you go.
Perfect.
There you go.
Perfect.
Move delta.
Wow. Man, you guys are so good. So, for example, if I wanted to do a 10 delta, I'm all the way to a 92, which is
12 points.
it's about halfway between 1 and 2 standard deviations, which is what you already said. You said 1 standard deviation is about a 15.
16. If you look at 16, that would be at 89, right?
yeah.
Which is a good move.
Perfect. Man, you guys are so good. Now, if I sign out now, is that saved like it is with Delta in there, or do I have to do it again?
Yeah, it will keep it.
Beautiful.
It's recommended to use delta rather than using dollar value or something like that.
Yes.
Say that again. I didn't get that. Yeah, best use delta for what?
What happens is the way delta is calculated, it takes into account the IV, implied move, and all other factors into it. Sometimes the stock is going to move in a very small range, and sometimes it's going to move in a very wide range. So it could jump, like in last couple of 2 weeks, a lot of stocks have jumped and the average range has moved and wider, right?
Yes.
So delta will take those things into account. If you
Yes.
are going to use, let's say for a stock like Tesla, if you're saying, okay, I'm going to use $20 and stick with it, then your calculations will go wrong when the stock moves very fast.
Yeah, and that's happened to me. Sometimes I think I'm a real smart guy and I say, okay, I'm going to do something at a 10 delta. And within 2 days, I'm screwed. I got to close it out or I'm losing money because,
Usually base your calculations on delta rather than the dollar value.
yeah, it's amazing to me how something can have a 90% probability of success. And within 2 days, you're in deep trouble. Happened to me many times. And so you have to close it out fast, minimize your losses. If you play options, there will be times when you don't make money. The presentation that I gave may have been misleading because I didn't show losing trades. Did I miss any questions, Rick Keller? Any questions out there?
And at this point, Barry is asking about your weekly leveraged ETF strategy, the sheets, the separate sheet for each strategy with all the parameters for trading on one sheet. He asks, are those sheets available with the most recent updates for LETFs?
I don't know if Gary's, the last one I sent out was probably a month ago and had his latest update, and I don't believe there's been any since then.
Yeah, he's talking about the sheets with the trading rules. I think you did that last month, right?
Yeah, I sent everybody the latest summary of all the trading rules. So if you have the handouts from last month's, what's that?
You froze up for a second there, Floyd, so we talked over each other. But yeah, that's what he's asking about, the sheets with all the trading rules.
Do you want me to find it and bring it up?
No, he's just asking, are those sheets available with the most recent updates for LETFs?
The
Well,
most,
he just needs the links to last month's slide.
just look at the last month's presentation, and that has the most recent trading rules for probably 6 or 7 different LETFs, mainly TQQ and SOXL, but there's others. I think FNGU's in there and FAS, and there's a few others. If you don't have the link to the last month's presentation, just send me an email at tqqinvestor@gmail.com and I'll send it to you.
And also just put the link to those in the chat,
Thank you.
your Google Docs thing.
Yeah, I can't even see the chat right now. I don't know what I've done with my whole setup. Maybe I need to stop sharing and look at the chat, and I'll just double click on it and bring it up. Let's see. I think that is the trading rules down here a ways. Can you see my screen?
No, you stopped sharing.
Hey, I'm a sensitive person. Be careful how you talk to me. I might cry.
I think he just wanted a copy. So I don't know if he had any questions about it, but he's just asking for a copy.
Do you
So I
see-
think-
is this what you were looking for?
Is Barry?
Close enough.
Yes.
Yes.
Okay. So the link is in the chat that will bring this up. And there's multiple sheets. This one's for TQQ. This one's for SOXL. This one is for TECL, FAS, UPRO, SPXL. And there's maybe that's the same ones. So there's multiple sheets here that show the variables that you put in. If you're using Trading View, it shows you what to put in for variables so that Trading View will give you the buy and sell signals. What else we got for questions, Rick?
Well, when Alex asks, these are the last question. Why not sell call spread on SOXL? I guess we're not doing spreads then.
Well, I'm not teaching spreads tonight. I do spreads all the time. You can do call spreads, or put spreads, or you can buy them, you can sell them. There's a whole different class on spreads, and the spreads takes a higher level of approval from your broker. But I love to do spreads. They are a viable trading strategy, and you can do spreads on stocks and ETFs that you don't own. A really cool spread I like to do is a bull call spread. And you can do a bull call spread in a way that has a very high probability of success. So you can earn $1,000 a week doing bull call spreads, and occasionally it'll go south on you, and maybe you'll lose $2,000 or $3,000. But if you just keep doing them overall, and if you pick a really low delta, you have a pretty good probability of success. You just have to be careful that if there's some crazy event that calls the market to go crazy in a direction against you, you can find at times that you almost can't get out fast enough before you got a $5,000 or $6,000 loss. And so just have to do them with wisdom. I think it's been a really cool presentation. I hope people found it to be valuable. I really appreciate folks coming in and telling us about the qualified covered calls and the put strategy and how to use Thinkorswim better than I've been using it. So it's been great for me. I hope it's been great for everyone else. I'll get the recording out probably no later than Saturday morning. And everybody have a great evening. Happy trading out there. I always wish God's blessings for everybody, and don't just focus on your primary driver in life shouldn't be, I need to make money tomorrow. Keep things in perspective, and let's keep helping each other out there. Have a really good evening. I'm going to sign off now. Thank you, everyone.
Thanks.
Yeah, it's been fun for me.
Bye.